In this video we are going to talk about Royal Dutch Shell. So before starting, please like this video and subscribe to our channel for future updates. Royal Dutch Shell, NYSE, RDS, B, is now one of the world's major oil and gas businesses. However, it aspires to transition with the rest of the globe and become a major global source of sustainable energy in the future. It will be costly to get from here to there. Is it worthwhile for investors to join in the fun? That dividend cut was a blow. Because of increased output from the onshore U.S. oil and gas sector, the global energy industry has been battling to balance supply and demand for several years. The economic shutdowns employed to halt the spread of the coronavirus resulted in a sudden and significant decline in demand, setting the stage for a dismal 2020. Oil and gas prices fell sharply, with the important U.S. benchmark West Texas Intermediate temporarily falling below zero. Shell's intention to slash its dividend by 66% in April 2020 is set against this backdrop. This is not what investors wanted to see, and it is unlikely that Shell wanted to do it. The corporation, however, determined that it needed to change course due to the headwinds. And it had to reduce one of its largest financial outlays, the dividend, in order to keep paying its capital expenditure goals. To its credit, the business has already begun to enhance the dividend, increasing it from 32 cents to $0.333 per American Depository Receipt, ADR, in the third quarter. This was primarily intended to convince long-term investors that Shell had reset its payout and was now planning to resume dividend increases. But is the narrative behind this energy behemoth interesting enough to warrant a purchase? A long and difficult road ahead. Shell has made a significant shift in its strategy, aiming to achieve net zero carbon emissions by 2050. It basically wants to become a lot greener firm as the globe moves away from carbon-based fuels. There's a lot of work to be done, and it will necessitate a significant adjustment in the company's objectives. Shell's current capital spending intentions are in the $20 billion per year area. It plans to devote roughly 40% of that to its heritage oil and gas activities, with the remainder going to what it refers to as its transition business, up to 40%, and its growth business, up to 25%. On the legacy front, management intends to concentrate its efforts on its most valuable assets in order to save production costs. With oil and natural gas prices still low, that's a smart decision, but it signals a stagnating or diminishing oil business. This is intended to be the cash cow that helps the corporation pay its shift to renewable energy, so cutting back here is good for the company's green credentials but may not be so good for its revenue generation aims. A difficult year. It would be an understatement to say that energy corporations had a difficult year in 2020. As economies around the world effectively shut down in an attempt to limit the spread of the coronavirus epidemic, demand for oil and natural gas plummeted. Furthermore, because to years of increased energy output in the United States, the worldwide supply of oil was high coming into the year. Due to a surplus of supply and a lack of demand, energy costs have plummeted. It grew so terrible that a key U.S. oil benchmark went below zero at one point. Though there were technical reasons for the decline, and the sub-zero pricing was only temporary, it was an unparalleled event. Nonetheless, it demonstrates how difficult the year 2020 was for oil and gas producers. In some ways, it's understandable why Shell had to make the painful decision to slash its dividend by 66%. However, there were larger picture considerations for this decision that needed to be considered. What's the next step? Shell's dividend decrease was unquestionably a setback for income-focused investors who had been tempted by the company's lengthy history of paying stable dividends. It may, however, have been the smartest decision the corporation could have taken. For starters, Shell wants to lower its debt, and freeing up funds that would otherwise go to dividends will help with that. Furthermore, the exploration and production sector is capital-intensive, with the corporation intending to sustain annual capital expenditures in the $20 billion range in the near term. Reducing the dividend should assist once more. The important thing to note here is that Shell's spending plans are a little different this time around. While it will not abandon oil, it will concentrate solely on its greatest assets and seek to sell the rest. The company's goal is to cut capital investment in the upstream sector from roughly 40% of overall investment in 2020 to between 25% and 30% by 2025. Transition businesses, such as natural gas and chemicals, will continue to account for roughly 40% of total spending. Growth companies, such as renewable energy and the company's marketing operations, will increase their share of capital expenditures from around 15% to between 35 and 40%. The transition from oil to renewables is the key story here, since it demonstrates Shell's attempt to change with the world. After lowering the payout, the company has established a goal of increasing the payout by 4% each year in the future. It has already delivered on its promise, increasing the dividend by the same amount in the third quarter of 2020. Although the present yield of roughly 3.5% isn't very high when compared to peers in the energy sector that haven't lowered their dividends, there are reasons to enjoy the income story here. To begin with, the S&P 500 index now has a dividend yield of roughly 1.5%. So, in comparison to the rest of the market, Shell's yield is quite appealing. And the goal for continued dividend increase, even at a modest 4%, is encouraging, as is the rapid action to fulfill that promise. Meanwhile, yearly growth of 4% actually outpaces the historical rate of inflation, which has been around 3%. Shell's plans to gradually boost the dividend's purchasing power over time. And it's all funded by a company that wants to leverage its cash cow energy industry to assist a transition to cleaner options. Moreover, the transformation will assist Shell in being a viable company in the long run. Given the growing importance of environmental challenges in today's society, it's difficult to dispute with that purpose or the need for such change. In many ways, 2020 should be viewed as a fresh start for Shell. Is it worthwhile to purchase? Investors aiming to optimize their income will find more appealing options in the energy sector right now, including Total, which is making a similar business move but has decided to keep its dividend. Maintaining the dividend, on the other hand, is not the same as increasing it. That could be the differentiator that attracts some investors to Shell as it strives to transition to clean energy. ExxonMobil and Chevron, in particular, have greater yields and are committed to dividend growth, but they aren't putting in the same effort to transition to a cleaner future. It's difficult to recommend Royal Dutch Shell as a great buy because there's still a lot of work to be done and success is far from guaranteed. Shell, on the other hand, is sticking to the plan it set out to execute thus far, notably including its first dividend increase. Meanwhile, with oil prices returning to pre-pandemic levels, the corporation will have more flexibility in repositioning its operations. That isn't a bad story, but it isn't particularly good either. Conservative investors aiming for dividend growth rather than yield may want to check into this stock, but only if they're searching for an integrated energy powerhouse. The trade-off between risk and reward. Shell's stock has been roughly cut in half during the last 5 years, but the dividend decrease has reduced the yield to around 3.9%. That's generous in comparison to the market, but it's significantly behind the dividend yields of peers like Total and Chevron, which also continue to defend their payouts. Yes, Shell has enormous plans for the future, but they represent a significant corporate shift that will not be cheap, and they are being implemented at a time when the corporation is also aiming to decrease its debt load significantly. Shell is likely to muddle through this change, but there's a good chance it'll be difficult. If oil prices rise, it may fall behind the energy pack due to a lack of investment in its legacy activities. Most investors would be better served by looking at alternative integrated energy companies for the time being, at least until Shell has demonstrated some headway toward the new future it is charting today. What are your thoughts on our video? Please let us know in the comments section below. If you enjoyed this video and would like to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.